oil price getting whacked? Lower prices ahead or just a correction? So I'm going to read this article because it's short from Market Watch that interested me in the last couple days. It's by Mark DeCombre. I'll attach a link to it in the information section of this live stream show after the show is over. So the title of this article is Oil Just Did Something It Hasn't Done in More Than 30 Years. Hint, it isn't good. Oil is on track for its 10th consecutive loss. A jolt lower for oil since peaking in October has helped crude futures to carve out a bearish record. That is even after U.S. benchmark oil on Thursday fell into bear market territory, defined as a drop of at least 20% from a recent peak. West Texas Intermediate, or WTI, crude for December delivery on the NYMEX, New York Mercantile Exchange, settled lower on Friday, marking its 10th consecutive decline and matching the longest skid for the contract since a similar stretch from July 18th to July 31st, 1984, according to Dow Jones market data. Bespoke Investment Group pegs the losing stretch as the longest skid since at least 1983. There's a chart in this article that's interesting to look at, noting that there has never been a streak of more than 9 straight days where crude oil has traded down on the day. Okay, there's a couple other charts in here. What's behind the downturn? Rising production and a softening in U.S. oil sanctions on Iran that included waivers for big crude importers like China, which helped to contribute to a whipsaw lower for oil prices. Indeed, just 5 weeks ago, oil futures had put in their highest prices in years. Lingering concerns about the global economy and expectations for sluggish corporate earnings in the future also have added to the downbeat mood in the oil industry. That atmosphere has lent itself to a downdraft in stocks. Okay, we'll skip the stock section because I've covered that ad nauseum with all the other stock market indices have been below their 50 and 200-day moving averages. Meanwhile, January Brent crude was also in decline and flirting with its own tumble into a bear market. Brent oil was down more than 19% from its recent October peak. Okay, so that's it for reading that short little article. There's some really good analysis of the oil market. I did a short video on this in January of 2018 about the global economy needs a Goldilocks oil price, and I really believe that that's a really good analysis of the oil market for like 20 or 30 minutes. Talking about how if the oil price is too high, then consumers can't afford it, too much supply comes online, and if the oil price is too low, then the producers of the oil, they can't afford their social programs, they can't afford to reinvest profits into more production, maintaining production, growing reserves, replacing reserves, etc. So this oil correction, oil is inherently volatile. There's also a lot of arguments that oil price is also manipulated. There's even mainstream people, like non-alternative media people in the regular financial media who say that the oil market is very heavily manipulated. So, you know, this correction in oil at this oil price, let me pull up my oilprice.com charts. We're at WTI $60.88 and Brent crude at $70.87 when we were doing this live stream show. So at that price, a lot of the deep water offstream companies, unless they hedge their productions, a lot of the offshore deep water oil producers, they're going to stop making some money here. And the shale oil producers, they have cut costs, but there's inherent problems in being able to routinely lower costs in shale. So it looks like there's a great interview on Real Vision Television from a hedge fund manager that was released on Friday named Russell Clark, and he goes in depth about the shale industry. So if you have a Real Vision Television subscription, I would check it out. He shows this chart for a company called Texas Pacific Land Trust. That's Thomas, Peter, Larry. And so this chart has gone parabolic since November of 2008. I think it's up over 4,000% in that time. And so that would be a potential. I mean, what he's talking about is that shale basically cannot completely continue to cut costs because the prices of land, especially in the Permian, are so high. And also there's just inherent problems with shale with its always high cost. And he said the frac sand companies are not doing as well lately. So you are seeing on that chart for Texas Pacific Land Trust, there's options on it. There's a lot of volatility lately. For you options traders out there, there would be an opportunity to play this with puts and calls. That stock could completely crash. It doesn't look like there's any support on the chart. It's already had a little bit of a correction. It could go a lot lower. Yeah, so the oil market, I mean, if the oil market continues lower, it can cause massive amounts of problems because of how leveraged the oil companies are. Now, the shale oil producers, they benefited from this rise in junk bond debt and pension funds desperate for income. So pension funds and private equity have funded a lot of this junk bonds for shale, but as part of their agreement for revolving credit facilities and other debt, the shale oil companies have had to hedge. So some of these shale companies are going to be in better shape because they're lower cost producers, but they're also the ones that are hedged that are lower cost producers are going to be in better shape than the ones who have more debt, you know, more poorly rated junk bond debt, higher costs, and are not as hedged if the oil price does continue lower. So I would expect, you know, the oil price in the short term with the downtrend, these trend traders will continue to maybe knock the price down, but the oil price will eventually probably rally at some point. I expect a lot of volatility in general in the oil market. Like I said, if the oil price gets too high, I would probably be bearish oil, and if the oil price gets too low, I would be bullish oil. So in the short term, anything can happen, especially with these high-frequency trading algorithms that really don't care about the fundamentals. I think also the other thing that wasn't mentioned in the Market Watch article was the inventories for U.S. I believe the oil inventories are high, and that's because, you know, the shale companies are producing more and more oil. There's actually kind of a glut for now. So it's not a global glut, it's a glut in the U.S. But the shale companies are not getting the full WTI price. There's a large transportation cost, and the shale oil sells at a discount. If the oil price does go lower, though, the refineries are the ones who are going to be making more money because they're going to be able to buy the oil cheaper and then blend it. They have to blend it with heavy sour crude. But I wanted to bring you guys up some... I'll answer listener questions later in the show. I'm going to try to keep it a little under an hour. But I did notice something very interesting. So, about Iran. So, there's this currency trader. This guy is named, you can follow him on Twitter, Professor Steve Hanke. And he's made a lot of money trading currencies over the years. He was like head of investment research for some private sector firms. He's made a lot of money trading currencies, you know, not quite as much as George Soros or Stanley Druckenmiller, although Soros probably had inside information and he manipulates markets and lies and cheats and steals and stuff. But Hanke, I've listened to interviews from him. He seems like a good, honest guy. Although I don't agree with all of his economic analysis, he is a really smart guy and really good with currencies. And according to his research, what he has said is that, okay, I'm scrolling through his Twitter, so give me a second here. He said that Iran's measure, okay, so first, Yemen's implied annual inflation rate as of November 10th is 66%. So Yemen has oil production that the Saudis are apparently trying to steal through their war. There's rumors that the Saudis' oil production is actually declining rapidly, and they're cutting a lot of their oil production with immense amounts of water. So they're flooding their wells, which is, if you're familiar with the oil industry, well flooding with water is bad. Use a ton of water to get out all this extra oil. That means the well pressure is down a lot. So there's been rumors now for the last couple of years that one of the reasons Saudi Arabia is attacking Yemen is to get their oil production. Okay, I'm scrolling through his Twitter. I'm going to pull up Venezuela. He says Venezuela's actual hyperinflation rate is 52,184%. And Turkey's inflation rate is 44%. Turkey doesn't produce much oil, though. So for the main point I wanted to bring up with Professor Steve Hanke was that he said that Iran's annual inflation rate as of November 10th is 268%. So that's when you combine Iran's desperate to produce oil, the U.S. has put sanctions on them. Now, the U.S. has given exemptions to, I think, 8 countries, including China and other trading partners, because those countries have to have oil and they do buy from Iran. So it's kind of hypocritical what the U.S. does. It's also hypocritical how the U.S. is using the SWIFT payment system, and threatening them for, like, economic sanctions on Iran. So that's, Putin and his economic advisors in Russia have talked about this at length for the last couple of years, how the U.S. uses SWIFT as an for economic warfare purposes. But Iran, the main point here about Iran and Professor Steve Hanke is Iran, despite their oil production, is going through hyperinflation. So 268% annual inflation rate. So the average citizen, even the government, even if you're a rich government person in Iran, you're not going to be doing as well. Your standard of living is declining a little bit. Now, if you're a regular guy in the street in Iran, you're going to be crushed by that type of inflation rate. It's really sad. Okay, checking my notes. Oh, so this oil land trust, which is TPL, Texas Pacific Land Trust, take a look at the stock chart on it. It's insane how parabolic it's gone. We'll talk later in the show about another stock chart that's gone insane parabolic since like 2009. That's Lululemon, the retail company. I took a look at their financials. They're not committing accounting fraud or anything, not that I can see right away, but there are some red flags there, and we'll talk about it. Okay, so I forgot to do this at first. Stupid disclaimer. Everything I say on here, any analysis or talking about the financial statements of Lululemon or talking about the stock chart of Texas Pacific Land Trust is just my opinion. I'm not a financial advisor. It's for informational and educational purposes only. Do your own due diligence. And that's it for the short disclaimer. I also want to thank my Patreon account contributors. I think there's 68 of you. Hopefully there will be more in the near future so I can continue to crank out these quality types of shows with analysis and not have suits with badges show up at my door threatening me. Okay, so on to the next couple topics. So if the oil price if I could sum up the oil price pretty quickly at the current price, if the oil price does go lower, the shale companies that are the most leveraged, that have shorter amounts of hedges, that have the most debt on their balance sheet and the highest costs, those ones would be in the most trouble. And also the deep water offshore companies. And so the companies that own the rigs like Transocean and Diamond Offshore, those guys are going to be very volatile now, more than usual, because they may get some cutbacks in the near future if oil prices continue to go lower. So I would look at the deep water offshore oil producers that tend to have more production in that, and then also the Transocean and Diamond Offshore. That's my dog barking in the background. I apologize. He's undisciplined. It's Bentley. Friggin' Bentley. Oh, and let's see. There was one other thing. Oh yeah, one more thing about the oil market. So the large cap oil companies, the integrateds, the majors, so your ExxonMobils, your Royal Dutch Shells, these companies, if you've looked at their stock charts and taken a look at their earnings reports, have not done well actually when the oil price rebounded. And that's because they're inefficiently run, and it's a point that Jim Chanos made about this as well, is that over the last like 10 or 15 years, there was an effort made by the CEOs and the management teams. There was tons of financial engineering in ExxonMobil and Royal Dutch Shell to basically try and smooth out the earnings of the company, which I think, in my opinion, with a very cyclical business, high capital intensive for oil industry, refining, etc., is not a good idea. But the management teams over the last 15 years, so this includes Rex Tillerson when he was running ExxonMobil. He looted the company, basically, loaded ExxonMobil with massive amounts of debt, many billions of dollars in extra debt. And so, even you would think when the natural gas price goes up and the oil price goes up that these companies, the larger oil companies, would do well, and the truth is they have not. They've struggled, they've lagged, their financials are nowhere near as good, and the reason is simple. It's because they've loaded way too much debt on their balance sheet, and a lot of that was done with share buybacks. ExxonMobil over the last 20 years, and I'm not saying they're GE yet, but they are on that path. So ExxonMobil, instead of when the oil price crashed and going and doing smart deals and maybe adding cheaper production or adding reserves to replace produced oil or natural gas, what ExxonMobil was doing instead was using tens of billions of dollars in debt to do share buybacks at higher and higher stock prices. So if you go back and look through the financial statements of ExxonMobil and their annual reports and all their disclosures for how many share buybacks they've done, they've basically been indiscriminately doing mass amounts of share buybacks for the last 15 or 20 years, regardless of the oil price, regardless of the natural gas price. And that's just not for a cyclical business, a high capital intensive business where the margins are tough. In the oil and energy business or mining, that's just not a sound business decision. But ExxonMobil has gotten away with it. So at some point, ExxonMobil will have to pay off that debt. They have managed to they kept the share prices from totally crashing when the oil price crashed in the past because of their share buyback program and not cutting their dividend. But in the long term, 5-10 years from now, that's going to be trouble down the road. Because from a fundamental perspective, analyzing a business, when you borrow a lot of debt and your revenues are not stable, like in the oil and natural gas business, and a lot of these large integrated companies don't hedge their oil and natural gas production, so the revenues are very volatile. But when you have a lot of debt on your balance sheet, that's not good. So you still owe massive amounts of debt and interest payments, and you're going to struggle to repay back the principal, and your revenues are fluctuating. So that's why it's dangerous for an oil and gas company, or a mining company for that matter, to go and borrow massive amounts of debt for share buybacks when your revenues are not that stable. But look at GE. Even GE, who supposedly had stable revenues, they couldn't grow their revenues, and they kept loading their balance sheet with more and more debt using financial engineering. So even if you have stable revenues, there's a threshold where you borrow too much debt, and even the cash flows you have still can't withstand it. So GE is getting in trouble for that. Okay, so I think I've talked about most of the stuff I wanted to talk about in the oil market. Looks like I've gone through that part of my notes. So I would watch, like I said, the deep water offshore oil producers and the rig operators. And if the oil price goes lower, the oil refiners like your Valero and those guys are going to benefit. It looks like some of the charts, especially on the oil services companies, are starting to break down as well. But October 2018, I forgot to mention this on recent live stream shows. October 18, the month of October 2018, excuse me, was one of the most volatile stock market months on record in 118 years of data. Pretty nuts. So I think there was one other month in like 2011 or 2013. The article's in the Wall Street for Main Street Facebook group if you want to go see it from a couple weeks ago. But this is how crazy for stock market volatility October was, that on a relative basis, Bitcoin was actually less volatile during the month of October 2018 than stocks were. I don't know if we'll see that again, at least in the near future, where Bitcoin for an entire month was actually less volatile up and down on a price basis than the stock market was. Okay, moving on, Michael Milken. So I saw this interview on Bloomberg. It was on their Bloomberg YouTube channel, one of them. They have a couple of them, with Michael Milken. He's considered the junk bond king. He was screwed over by the government pretty much the same way that Michael Flynn was, and how they threatened Michael Flynn's son to indict the son, and you know, with legal bills in prison. They did the same thing with Michael Milken, the junk bond king. They threatened to put his brother in prison who didn't commit a crime. So Michael Milken actually pled guilty to a crime he didn't commit and served a bunch of time and paid massive amounts of fines. But Michael Milken, who founded junk bonds, he was talking about the junk bond market recently. So he's a junk bond expert. He invented them, basically. And so he democratized them, essentially. And he was talking about how basically the mainstream media, the regular financial investors, the pension funds, so all the regular people in the financial industry are overlooking at exactly how much debt the large cap dividend stocks, the blue chips, he said, that everyone is familiar with, you know, in the Dow, the large Dow companies, a lot of the larger S&P 500 companies. He said that they've way overused, taken advantage of, or overplayed their hand with their credit rating and their cash flows. And he said that they've borrowed too much debt. And he said over the next 5 or 10 years or so, he said there's going to be hell to pay. And he said there's going to be a lot more General Electrics. So I would keep an eye on that. So just because you think you own a Johnson & Johnson or some of these other companies, I haven't looked at Johnson & Johnson specifically, but that's like one of the main blue chips I can think of. I'm sure there's a lot more. Apple is another one. Recently, and this is a big red flag to me, Apple is not going to be announcing their unit sales anymore. So that's a red flag to me. They've loaded the balance sheet with debt. They've done share buybacks. And so now they have had revenue increases, but the way they've done the revenue increases is they just keep raising the price on their iPhones and their iPads and stuff, but the total unit sold is actually declining. So they've made up for unit sales declining, and they're on their way, I think, to becoming third in market share for smartphones. So the way they've made up for this is with increasing the price on people who are loyal to Apple, to the brand. They're willing to pay, I think, now way over $1,000 for a new iPhone. But there's inventory buildups, and so it's a red flag to me with Apple that they are not going to be reporting the unit sales. Watch Grant Williams' presentation at the Cambridge House on YouTube. Is that a new video? I haven't seen it yet. I've been trying to get Grant back on here for another interview. I've had Grant on a couple times over the years. He's just so damn busy. It's tough to get him on. But I will take a look at it later. Okay, covered that topic. Okay, so Lululemon. So if you look at the government economic data, I've been following some economists who looked this over, and listening to hedge fund managers talk about this. And based on the Trump tax cuts, the ones who've actually benefited from some of the economy doing better the last couple of years, based on the tax cuts and some of the other programs that the government has implemented and some of the private sector investments. So there's been a lot of people who have gotten the tax cuts. And so what they have done with their up to $10,000 extra per year approximately, not everyone's getting that type of a salary increase, but there's been a huge amount in credit card spending. And if you go through the government data, what the government data is saying the credit card spending is going on is on retail and restaurants. And the retail more specifically is on new clothes. So in my opinion, that's not sustainable. So maybe for the next year or two, there may be continued increases in that. But as people, continue to increase credit card debt, even because they think they have more income coming in, if whether it's sustainable or not, and eat out at more restaurants and also spend more money on retail, I would say that that's not sustainable. And there's been big rallies lately in restaurant stocks and retail stocks. So I would look, if you're a short seller or you're looking to trade volatility, I think the credit card companies, some of those, there's a handful of them, and then also restaurants and retail over the next 2 years, those are going to be the ones because they've had enormous rallies where they're already kind of priced for perfection, especially a company like Lululemon. So Lululemon, if you look at a stock chart of Lululemon, which is LULU, Lulu, it's up, I think, almost 5,000% since 2009. And so there is fundamental justification for this. There's articles out there talking about how a lot of either millennial women or older women are switching from wearing jeans to switching to yoga pants. But there's enormous amounts of competition. And when I dug into the financials for Lululemon, first of all, the stock analyst reports for Lululemon, all the stock analysts covering Lululemon, I didn't see any bearish ones. I just saw bulls with differing price targets. And so everyone is basically assuming that I think Lululemon in their last earnings announcement had a 90% revenue increase year over year. These stock analysts who research Lululemon and are paid to cover Lululemon are basically thinking linearly. And so they're way too bullish in my opinion. They're assuming that Lululemon over the next 12 months will pretty easily be able to continue to grow revenues massively and even basically double earnings. And so they may be able to do that, but the stock is already pricing that stuff in, and there's higher and higher price targets for Lululemon. So if they miss either on revenues or earnings, then the stock could totally crash. It has had a little correction the last time I looked at it last week, but it has not had a big price crash yet. So I would expect a lot more volatility in Lululemon given the super bullish sentiment there. And how the analysts are on all the stock analysts covering the stock. There's like no negative analysis on Lululemon. But when I did look into the financials, so I didn't see any accounting fraud or anything like that. I didn't spend a lot of time on it. But what I did see on Lululemon, though, was that over the last couple years, they have doubled their revenues. However, despite them doubling their revenues, they have not done it super efficiently. So they have not increased their net income. So their net income for the company in their annual reports from like about 2 or 3 years ago, I think was $425 million for a year. And despite them more than doubling their revenue over the last couple of years, their net income is flat. So what that tells me then is that, okay, the company is not going bankrupt or anything like that, but they're not efficiently growing the company. Their costs are rising almost as fast. The costs to grow the revenue are rising almost as fast as they're growing the revenue. So they're inefficiently growing the company, growth for growth's sake, as my friend Nolan Watson likes to say. And, eventually, when you just continue to grow for growth's sake and you're not doing it efficiently and your margins are not being maintained or expanded, and to me it looks like there is starting to be margin erosion in Lululemon. Jesse, I interviewed Brent Johnson about the milkshake theory as soon as that video came out in March, and I was actually planning, that's funny you ask, I was actually planning on having him back on the show again soon. He was supposed to actually be on Friday. We had to reschedule. So I will work on getting Brent Johnson back on the show again soon. I was going to follow up with that. But I think a lot of the stuff he's saying makes a lot of sense. I don't fully agree with him on everything, but I think a lot of what he's saying makes sense, though. Okay, checking my notes again. Yeah, so I would watch Lululemon if they have one or two bad quarters, that stock's going to crash, because there's the optimism, the amount of bullish sentiment in that stock for Lululemon is extremely high. And I mean, how many $100 pairs of yoga pants can someone actually buy? There's tons of competition coming. Lululemon is now, when I've looked at the company's website and stuff, they are spending a lot of money on research and development to try to maintain their margins. So they are trying to. And the management team would say, oh, the reason our costs are higher is we're spending a lot of money on growth CapEx. But I would point that eventually they're going to reach a saturation point where people are not going to want to pay $100 or more for a pair of yoga pants. So if you already own 5 pairs or 7 pairs or 10 pairs of Lululemon yoga pants, adding that next marginal couple of pairs is not going to be really useful to you. So they're going to hit a saturation point. And the stock price is priced for perfection if you look at the chart of the stock and the valuation. You should not short a stock on valuation, but I would watch for the margins. Because as soon as those margins start to really erode, the stock's going to totally crack, in my opinion. Again, not financial advice, stupid disclaimer. So do your own due diligence, but I would expect a lot more volatility in the Lululemon stock. Let me just put it that way. There are other retail stocks and other restaurant stocks that are going to have a lot of problems. There was one restaurant stock, I won't name its name, that I think is extremely poorly run, and it has tripled in price in the last year. And I don't think it's sustainable, because I just ate at one of the locations in the last couple weeks, and I mean, there's so many problems with the fundamentals of the restaurant. I could name you like a dozen problems with the restaurant, and yet their financial numbers, they're saying that their check values are going up and all this other stuff. And you know what? When you look at the Yelp reviews and all this stuff, they're not saying what the management team is telling, the market and the stock analysts who cover the stock. Okay, so let's take a look at gold and silver, and then I will touch on some listener questions. I think I covered most of the stuff here already. Oh, quick wrap up here. So the dollar index is at 97 now. So if the dollar index can hold 97, above 97, close above 97 for at least a couple days in a row, it's going to move up to 100 pretty quickly. The dollar index at 97 is already bad. The dollar index getting to 100 or 101, 102 is very, very, very bad. Okay, it would put even more pressure on the emerging markets, European banks, European governments, corporate debt, especially if the Fed decides to hike rates, a combination of a strong dollar plus rate hikes. Surprisingly, though, the VIX is back down to 17.36. So only a couple weeks ago, the VIX was at 26. It's already back down to 17. I would not be shocked if the VIX whipsawed back up in the next week or two. I think we're going to see a lot of up and down movement in the VIX. However, you should not, if you're a retail investor, avoid the leveraged VIX ETFs. Avoid them at all costs. Okay? This is not financial advice, but the better way to maybe look for trading VIX volatility is to set up volatility trades on the general stock market indices or other normal ETFs. Avoid the leveraged ETFs. I know way too many people who are smart but greedy and don't understand how the leveraged ETFs work, and they've messed up on all their trades. Okay, so I think I've pretty much covered... Oh, gold and silver. So we are at 1209 gold, give or take, and 1416 silver. We are at a silver price now that is very, very bad. It's just when you think the silver price can't go much worse, it does. We really need copper miners to go bust. We really need copper miners to go bust that are producing the silver byproduct. Coeur d'Alene, in the last week or so, they're a higher CDE, they're a higher cost primary gold and silver miner. They're actually transitioning more to producing gold, but they just laid an absolute total egg on earnings. Goldcorp had bad earnings. So, and I've talked about this at length in my videos. First Majestic Silver Investor Relations must have seen my analysis of my silver miner analysis that mentioned them in the video about 2 months ago, because I got an email from them sending investment bank analyst reports to me, unsolicited. But, you know, the research from the First Majestic Silver stock analysts that are covering the stock wasn't super popular either. They said the company's running out of working capital. First Majestic Silver had $100 million in cash on the balance sheet. They've depleted it down to $70 million because I don't think they want to go to the equity markets now and dilute the stock more. Even though they might need to, they just don't want to do it because they had to do dilution, remember, to acquire the San Dimas mine. So they don't want to do any more dilution to fix their balance sheet, even though they probably should. If the silver price does have a big rally, I think First Majestic Silver will dilute almost immediately. So with this, if the oil price does either stay at these levels or go lower, this would help a little bit at least the primary gold and primary silver miners with their margins. However, the oil price, which the miners use for diesel mostly, would have to stay there for a while or go lower for a while. And I don't know if that's going to happen, but we'll see. But these primary gold and primary silver miners, most of them are so mismanaged that it's going to be very tough. You're going to see, because of how badly a lot of these larger gold and silver miners are doing, including now Goldcorp and others, that you're going to see them have to sell like streams or royalties. So you're going to see the Franco-Nevadas, the Wheaton Precious Metals, the Royal Golds, the Cisco Gold royalties, the Sandstorms. You're going to see them just step up and come in and clean up if this continues with lower gold and silver prices. Oh, thanks, Mandingo Warrior, for the $10 super chat contribution. I appreciate it. Okay, we're going to answer a few of these listener questions. I think I covered most of the topics I wanted to cover in this short little live stream. Shielded by God. Oil is highly leveraged. There's a lot of oil futures contracts. There was a record amount, I think, end of last year, earlier this year. There is a lot of manipulation in the oil market. I know a number of hedge fund managers that are 100% convinced that the Saudis were trying to manipulate the oil futures price curve to bankrupt the shale producers, and it just didn't work. The shale producers were able to raise a lot more capital through junk bonds and sell more shares, and then also miraculously, and some of these shale producers deserve a lot of credit, they're able to lower their costs a lot more in total and a lot faster than the Saudis and other oil producers thought they possibly could. But I think there is limits to how much production, how much cost cutting these shale producers can do. Because shale is very capital intensive, there is a lot of moving parts to it. And like I said, the land costs for shale are super high. So until the land costs totally crash, there's not a lot of the other costs for shale production cannot be cut drastically yet. So it looks like the largest costs that could be cut are the land leases, and it doesn't look like that's going to be cut anytime soon. The high cost of land leasing for shale. And in fact, I think Pioneer and a number of the other shale producers, they've had to merge. There was no cash involved in the mergers. They had to merge in all stock deals to try to get some type of consolidation power in the industry. So I don't know if it's going to work out with these mergers. A lot of times these mergers don't work out, but there's an attempt to do that right now. So these shale producers are merging without any cash changing hands. Scott, Trump wants oil at $50 or so, need cheap energy for a strong economy. Yes, this is correct, and Trump wanted lower energy before the November midterms, but it's not like, I don't know if people who voted for a Republican or for a Trump-endorsed candidate, how much the oil price affected that. I think the economy, the fake government statistics saying that the economy is better, that may have motivated some people. Some people did benefit, though, from the Trump tax cuts, and they have gotten wage increases. Not everyone, but some people have. In general, I think the government numbers are total lies. All the governments, so China, the European Union, the United Kingdom, US, almost all their economic data is totally fake. Oh, yeah, I was going to bring up last point. So Brenda Snipes, this Florida recount lady in Broward County. I mean, after all the scandals she's been involved in from a liberty standpoint, and Florida has had a Republican governor, the state congressman, the state Congress in Florida is controlled, I think, by Republicans as well. How the hell does this bureaucrat in Broward County, who's shady as hell, who's allegedly committed all these problems, Either she's inept or corrupt or a combination of the two over the last 15 years. How the hell does she still have a job? What is it, a government employee union? How? She should not have had a job in the first place before this election, given her background, her shady background. And this is the problem with the U.S. You have all these powerful, corrupt, or inept bureaucrats that are like Wesley Mouch from Atlas Shrugged, and they can basically ignore reality or ignore what the population voted for and just go and implement their own agenda. The bureaucrats have way more power over things than most Americans realize. And this is the danger of the big government that the U.S. has right now. And it also, another point, it proves that the U.S. is the world's largest and most dangerous banana republic in world history. Lord Humongous, everything is highly leveraged. Rich wants to know about oil sands. So the oil sands, the pipeline is being built, but the problem is a lot of the Canadian oil sells at such an enormous discount. So it looks like the pipeline is going to fix some of the transportation costs, but the fact that a lot of the Canadian oil sells at such a discount is a problem. So the Canadian companies then basically, they have to hedge to protect some of their cash flow. But I don't know, some of them have just such large leverage balance sheets. I would stay away from the ones with the worst balance sheets. You have to look for company, if you're going to play that space, you have to look for companies with the better debt to cash flow ratio and debt to equity ratio. Because if they are wrong on the oil price and they have too much debt on their balance sheet, they're in trouble. That's actually a good rule of thumb with almost every oil company or mining company. Although when the price is in the cycle, it's going bullish and the price is going higher, the most leveraged companies will do well, but that assumes that they survive the bearish part of the cycle. That assumes that they don't go bankrupt during the bear market. Personally, I wouldn't want to take that type of risk. You can take small positions in that. That's how I made a big gain on my copper trade, my speculation with Lundin Mining in the 2008 financial crisis. In 2009, I knew China would reflate with their stimulus program and that copper demand would spike artificially. And so Lundin Mining took off and that stock went, I only bought a couple hundred shares though. And that stock, I think almost only 500 shares, but they're 30 cents each. And I was willing to lose the money, but they were backed by billionaire Lucas Lundin. And I knew the copper price would rally based on what China was doing and the reflation, what the central banks were doing. And the stock did go from 30 cents to $5 in about 18 months. But I sold all my shares because I knew that like it was just a trade and it was not a long-term investment. Lord Humongous, silver certificate standard. Yeah, the U.S. should be back on a silver standard, but the people in power, the banks don't want it, the Keynesians don't want it, a lot of people don't want it. They don't understand real economics, they're brainwashed, they're either uninformed, they're either financially illiterate, or they're brainwashed. R. Ann Rousseau, is the hit to prices reflecting the beginning of the economic downturn? For oil prices, yes, it might be. The global economy is slowing down. There's a lot of evidence of this. There's a lot of articles on Zero Hedge and other places about the Chinese economy slowing down. We know emerging markets have not been doing well lately, so yes, that might be part of it. But there's a limit to how low the oil price can go before it starts to cripple the producers. Venezuela is already crippled. One of the reasons, besides socialism and all the corruption and ineptitude in Venezuela and their corrupt government with Chavez and Maduro, one of the main reasons that Venezuela is collapsing rapidly is because the oil price is down so much. When the oil price was much higher, it was hiding all the rot and corruption because the Venezuela, I think 98% of their export revenue is from oil, which is a totally unbalanced economy. Eventually, after Maduro is gone and Venezuela gets reformed, their economy is going to have to fix that. I mean, they have agriculture, they have mining, they should have tourism. There's a lot of beauty in Venezuela, but until like private property rights are restored, rule of law is restored, people respect capital and investment and stuff there, small businessmen are respected, entrepreneurs are respected there, things are not going to change in Venezuela. Saudi Arabia wants to leave OPEC. Yeah, they mentioned that, but they were also talking last year about joining with Russia more. So, I don't know, it could just be a smokescreen that they were putting out. OPEC did try to bankrupt the shale producers. They tried really hard a couple years ago, and it did not work out. The cost of energy is rising, which we are compensating for in the short term by using financial gimmicks to make affordable, when all we're really doing is creating future promises that cannot possibly be repaid. Okay, those comments were by RR. In general, I agree with that. The shale oil initially was not economic at all, even at $100 oil, and that was totally financed at enormous losses with junk bonds and, you know, almost unlimited share or equity issuance and dilution. And now some shale producers are starting to make somewhat of a profit and some free cash flow. But in general, I think most of the shale producers are not really that efficient. And so basically, it's going to be really tough for a lot of the shale producers to continue to increase oil production and also to consistently make earnings and free cash flow. Yeah, without that cheap capital from the pension funds and the Wall Street investment banks and the central banks manipulating interest rates lower, the pension funds are desperate for income and yield. So without financial repression from all these governments and central banks, and the pension funds desperate to get any type of income because they funded a lot of the shale oil boom, then I don't think shale would have gotten the funding in the first place. Maybe we could debate whether or not that was done intentionally or not. But now the U.S. is a large oil producer and natural gas producer because of shale, because of the infrastructure and investments there. So the U.S. has an advantage now compared to many other countries. So the U.S. has a lot of natural gas that they can produce and or export, and a pretty good amount of oil production. Although it's not necessarily lower cost oil production, but it is oil production. Yes, Scott, the people in power don't want a gold standard. So they might, with their own money, be buying gold and silver and real estate and artwork and other stuff to protect themselves, but they don't want their government or central bank to be forced on a gold standard. In fact, I think from what I've heard, Danielle DiMartino Booth was talking about this, and she worked at the Dallas Federal Reserve. She said people inside the Federal Reserve, her contacts, are openly talking about a debt jubilee in the, I don't know, next 5 or 10 years. She didn't give an exact timeline on that. So I don't know if you can do something like that. You can't do something like that on a gold standard or silver standard or bimetallic standard. There's just not the flexibility to do stuff like that. I'm not familiar with the Apple television, Jesse. The main sellers for Apple are the iPhone and the iPad, right? And then their computer, the MacBooks. So those are what their 3 top sellers. The problem is the smartphone market is saturated. You have the Chinese smartphone producers and the Korean smartphone producers. The Chinese smartphone producers have essentially stole all of the IP from the American and Korean ones. And so the Chinese ones are knocking off really quality smartphones at much more affordable prices. And so the companies like Samsung and Apple are not doing nearly as well in China. So according to Fred Hickey, who's the high technology strategist, one of the top technology analysts in the world, he says that Apple is now only 3rd in market share for smartphones. And the smartphone market share is saturated. So it's just in about 10 years or so, the amount of smartphones sold, it's slowing down a lot. So a lot of people who wanted a smartphone have one. Some people have 2 or 3. If they're hustlers or dating more than one girl at once, they're players. The milkshake theory, I think, is a good theory. The U.S. hasn't done quantitative easing technically since 2014, I think October 2014. And yet, despite the U.S. not doing it, and the Bank of Japan, the European Central Bank, the Swiss National Bank, and the People's Bank of China doing massive amounts of QE, a lot of that capital that's been created in those other central banks and countries and emerging markets, a combination of the other QE and fly capital has come to the U.S. in the asset prices. So the U.S. has benefited from that. When the asset prices go higher here in the U.S., that means more tax revenues, more capital gains tax for the federal government. But that's starting to reverse now, because now you have the budget deficits in the U.S. exploding and blowing out. And over the next 12 to 18 months, there's going to be real questions about how treasuries are, who's going to buy the treasuries. So Victor Sperandio, in his interview a little over a month ago, may have solved some of it. I mean, the large banks I think the large U.S. banks are helping cap the yield on the 10-year. But I don't know exactly how much, but they are allowed to. Of course, if you believe what Victor Sperandio says in the argument he's laid out, that when the 10-year Treasury yield or either the 30-year yield is about to blow out and create a huge bond market, a run on bonds, or the 10-year is about to blow out and get above that 3.25 number that Jeff Gundlach was saying, it seems that someone magically comes in and just hammers the crap out of the 10-year and knocks it back down and prevents that run on bonds, that big run on bonds that many people like Michael Pinto and many others have been predicting. So despite, the U.S. running massive amounts of monthly budget deficits and record amounts of annual interest payments, the 10-year Treasury yield has managed to stay in a range. Now, Ronald Stuffley put on his Twitter in the last week or two something very interesting. Now, a couple years ago, when the stock market did crash, the yields on the 10-year did go down a lot. A lot of people retreated into treasuries, 10 years especially, 10-year treasury yields. So when the stock market had a big correction a couple years ago, the 10-year did go down a lot, the yield. But recently, that has not happened. So the 10-year hasn't broken out. There hasn't been a big run on bonds yet, but the yield on the 10-year has not gone down a lot. So he thinks that that's potentially a turning point or a paradigm shift. Gold okay, I just missed that question. Someone was asking why gold's so low. Well, the dollar's having a rally. Ultimately, I think the dollar and gold will start to rise together. There's a limit to how much so people talk about gold can go down unlimited, that it doesn't matter how much gold supply, but I think the gold market is tight, and I think that the annual mine supply for gold is needed. In fact, I think China's buying around 100% of China and India together are buying 100% or more of the annual gold mining supply. So gold can only, look, so if gold goes to 1,100 for a while, or 1,000, or a little bit lower than that for a while, even the lowest cost gold producers are going to be in trouble, because they've been spending the last 7 years in the paper bear market cutting costs to the bone. This merger with Barrick and Randgold Resources, I think, not only will it add some reserves to the combined company, but I think it was done out of desperation to cut at least 20% of SG&A costs, selling general and administrative costs. So for the current amount of gold production, it's going to be almost impossible for the current amount of gold production to stay at these levels, given the current gold prices. There's just no incentive to invest in new discoveries and increasing production, finding reserves. You're going to see very few gold mines brought online. Most of the new gold mines brought online are like medium-sized ones. And so you have a lot of the larger gold miners that are producing massive amounts of gold, and they're wondering how they're going to economically replace their current gold production and their reserves. So it's not an immediate problem necessarily over the next couple weeks or couple months or even the year, but over the next couple years, it's going to be a big problem. Yeah, it'll be, so there's a couple comments here on the 10-year yield, so it'll be interesting to see what happens. If Victor Sperandio is right, they will be able to keep the 10-year yield despite the U.S. Treasury borrowing more and more and more, and the Federal Reserve not publicly buying things with QE. They will be able to keep the 10-year yield below 3.25, but we'll have to wait and see. I don't know all the stuff that's going on behind the scenes. I have some good sources, and I try to interview experts on this stuff better than a lot of the other YouTube channels. So we don't know exactly what's going on behind the scenes. I do know for a fact that they will change the rules. So maybe they force pension funds to buy treasuries. Even though they know the pension funds won't make any money off of it, they force pension funds to hold more treasuries to prevent like that big spike in treasuries. We don't know. That's an educated guess. Well, we're all debt slaves. Lord Humongous, we are all debt slaves. We are all wage serfs or debt slaves. The people who wake up are trying to get out of the system, but it's a lot easier said than done to become financially independent, build your own business online, have diversified investments, producing cash flow. It's a lot easier said than done. Okay, well, I think I see a lot more comments on debt. And yeah, the debt system's unsustainable. And China's hyperinflating, and all these other major governments are all in problems. Canada is having enormous problems now. Australia is having enormous problems now. The emerging markets are having enormous problems. The corporate bond market at some point will break. We're seeing a lot. I just saw a chart on a Spanish bank from Raul Pal on his Twitter, BBVA, the Spanish bank, and it looks like they're about to need a bailout or go totally bankrupt, similar to Deutsche Bank. They may go first. So the Spanish banks are also in trouble. They have a lot of bad debt from emerging markets in South America. Oh, Europe's a mess. The U.S. has been keeping Europe on life support for a decade. Without the central bank currency swaps that the Federal Reserve has been giving the European Central Bank to keep European government debt and European banks alive and European corporations alive, I think there would have been total collapse already. I mean, there's already social unrest there, and their culture is being destroyed in Europe. But the ECB wasn't supposed to do quantitative easing, and they did it, and their balance sheet exploded to over $5 trillion, and they're claiming that next year they're gonna stop QE. Maybe. But then the Federal Reserve is going to have to bail them out, or Europe's going to have to be totally restructured. Did you guys see, though, that with NATO, that apparently the European Union wants their own army. So they want to potentially fund their own separate army away from NATO, away from the U.S. So the U.S. is having like a Cold War that's ramping up with China, and Europe is looking at potentially distancing themselves from the U.S. with NATO. Although Europe has never committed to spending tons of money on military, especially because the U.S. was paying for all of it for a long time. So it'll be interesting to see if it's all talk or they're actually going to do it. But I think overall, as we wrap things up here before I shut down the show, is that you have all these major economies, whether it's China, the U.S., the European Union, everyone is fighting for a larger and larger slice of a shrinking economic pie. So the global economy, if you think of it as a pie, it is shrinking rapidly. And that's because inflation is bad, people are taxing, people are raising tariffs and trade wars and things like that now. And so you have all these major countries that are fighting, and they're lying about their inflation data, they're lying about their jobs data, they're lying about their GDP so they can borrow cheaper. And so they're fighting over a shrinking economic pie. They're claiming the global economy is growing. It's just not true when you factor in a real inflation rate and all the other revisions and adjustments in the GDP. And GDP is bogus anyway to begin with. So this is not going to end well. A lot of it's based on economics and stuff. So if the global economy was doing better, I don't think you would see the trade wars and the tariffs and all this stuff. So that's the truth. So whether the government's admit it or not, the global economy is not doing as well as they claim. Okay, guys. Well, I'm getting tired and I want to relax for the rest of the night. So everyone have a good rest of the week. And I'm going to try to get some more good interviews out there for you later this week. Okay, bye.